Mm. Um, okay, thank you so much for your time. Welcome to the class today. My name is still Ibrahim Taiwo, and on the platform of FCA, First Choice Accurate Success Link. I'm in the best tuition house in Nigeria currently. Now, um, thank you, my host. Good evening, sir.
Good evening, sir. Congrats, sir.
Yeah, thank you. Now, quickly, let us manage the time. Now, based on in the last class, we discussed extensively on ethics and so on and so forth. There are topics we discussed yesterday. So now today, that the last class yesterday, we stopped at tax audit and investigation. So the next 5-10 minutes, let me talk on this tax audit and investigations. Then I will move on to the next topic. So the tax audit and investigation, we have explained the last time that audit is when you are looking at, when you are independently reviewing a statement to know whether that particular statement reflects what actually happened in that entity. Now, but when we are now talking about tax audit, that audit is now being directed towards to the tax payment. That is more if you want to, if the tax authority is determining whether the tax you file with them or the financial statement you want to file with them for tax purpose are actually correct, and the tax payments, the tax you are paying are actually also correct. All these are what they are looking at when they say they are doing a tax audit. I hope you're getting that. And that tax audit is compulsory that they should do it. And why are they doing it? It's not to determine fraud. No, it's to show whether their errors, their omissions, their non-compliance with laws, and so on. So that's more of the reason why they do tax audit. And when we say tax audit, we have two types of that audit. We have the desk audit and we have the field audit. Now, the desk audit is that audit that is carried out in the tax office. I hope you know that. So that means that if you file any of what your financial returns at the end of the year and also your capital allowance computation and all the tax you're supposed to pay through your self-assessment filing, they need to look into it and see whether that submissions are correct, are free of errors and omissions. If that is being done, they are doing a desk audit. It means that desk audits are done in the office of the tax authority. But the field audits, if the tax authority are not comfortable with that tax audit, or they still need more clarifications, and they think they need to probe in more into what you have submitted, to ensure that you have actually done the right thing, then they go into field audit. It means that inadequacies of this, when they are not satisfied with tax audit, that's where field audit is what is done. And field audit is carried out when they come into your office. They will come and visit you for that field audit, So when they are doing a field audit, it means that the tax authority will have their members that will come in to visit the taxpayers' office and carry out more extensive audit on the financial statement and other relevant documents, so that they can ascertain whether what you have submitted to them are actually correct. So that's where we'll have a field audit. So the field audit, I've seen them asking the field audit before. Please note, field audit, they will ask you what are the stages of field audit. If you check your material, you will see the stages of field audit. If the tax authorities are coming to your company to carry out a field audit, then definitely there are stages they have to go through. The first stage is this selection of taxpayers to be audited. They need to identify which taxpayer are they going to visit. They have numerous taxpayers. They have to select. Out of all these taxpayers that their files reside with them, which one out of all these taxpayers are we going to visit? So there are criteria. If your company is very unlucky and they're able to pick you, then obviously, most importantly, when they come for visits, most probably they will raise additional assessments. That's Nigeria's situation anyway. Now, for selection of taxpayers to be audited, there are criteria of selecting a taxpayer to be audited. Look at some of the criteria. So if you're explaining it to them, the first stage is selection of taxpayers to be audited. Why the criteria for this selection is that taxpayer with refund claims. If you are telling the tax authority that you have a refund claim, that they are owing you, then you are a subject of tax audit. Also, taxpayer with nil returns. If you are telling them that you always make losses all the time, you are also susceptible to tax audit. Also, if you are information from intelligence units, sometimes they receive information from their intelligence unit. They have intelligence unit that gives them information about a particular taxpayer that is there to visit, and also the directive from higher government authority. Directives can come from the above that they should go ahead to go and carry out a tax audit on a field audit on a particular event. So these are some of the criteria of selecting a taxpayer for tax audit for field audit. Now the stage 2 is after they have selected your company for tax audit. The next thing is they need to do preliminary review of the selected taxpayer's file. They need to do a preliminary review of your file and need to look at what exactly what are the details of your files, how have you been making profits in the past. They need to look at the ratio. They can even use an analytical review to also look at the trend of the performance in the past, so that cannot be the basis of knowing what and what they are going to discuss with you when they get to your office, or what they are expecting. So that's preliminary review of the selected taxpayers file. They have your file with them, so they will review it, they carry out review on it, and with that review, it will give them first-hand information about your organizations. After preliminary review, they go into notifying you. They will notify you. That will be in written form. It will not be oral. There will be a letter sent to you of the date they are coming, the reason why they are coming, document that you are supposed to provide for them when they come, and so on and so forth. All these informations they will require you to submit it. They will contain that in that letter, and they will forward that letter to you, intimating that they are coming. And in the fourth stage is what they will now do pre-audit meeting with the staffs of the organization. When they come into your office, they don't just barge into your business premises. They will come in and first have a meeting with the relevant stakeholders of that organization. So mostly the financial stakeholders like the CFO, the management accountant, and so on. They need to have a periodic meeting with the staffs of the organization before the audit work. Now, why are they having the periodic meeting? The reason why they're having that meeting is to acquaint the company and their staffs of the reason why they are there, and they will also ask them questions. Before they go into the tax audit, and they also solicit for their support because of that meeting. I guess what I'm saying. And the next thing is what actual field audit. After they have finished the meeting, they go into the field audit. They start reviewing the files, ask them of files which they have indicated in that letter they sent to them. They start looking into it and so on, so that they want to look at discrepancies and so on. After the actual field audit, then after finishing the field audit, they carry out what we call a post-audit meeting again. So technically, there are two meetings that we're going to have. The audit meeting, that's before the audit activities, and the post-audit meeting. That's immediately after the audit activities, they do post-audit meeting. And if they are doing this post-audit meeting, this should be held immediately after the end of the field audit. And why are they doing this post-audit meeting? The reason why they are doing the post-audit meeting is that they want to also ask more other information that ordinarily they are not privy to, during the course of their actual audit exercise. So they want to ask directly from the work of the staff, so other information that they are able to glean from the audit exercise, by themselves from the audit exercise. After the post-audit meeting, then they have interim audit report. They have to document. They have a report they make. I guess in that report will capture all activities that have been brought up to that point, and all what they are able to get up to that point. And that was meant for the consumption of their superior, of the tax authority superior. The superiors, they have cadres. I guess that report is what they use to review what exactly they actually carried out during the tax audit. Now, this interim tax audit report will now be looked into by the regional headquarter authority or auditors. It means that in the tax authority, they have auditors in their hierarchy that will look into interim audit report of all field audit exercise. And they are the one that will now come into positions of whether that particular taxpayer is going to pay additional tax. I hope you get what I'm saying. After they have duly reviewed the tax, they have duly reviewed it. So with this, if you look at it very well, that the post-audit review by the regional headquarters is meant to review what has been done and also to come into a position of whether there should be additional tax payment. And the next one is reconciliation meeting. Now, after the review, they will come to positions of what amount extra are they going to pay. I hope I get what I'm saying now. So if that's the case, then there will be a reconciliation meeting. Reconciliation meeting with the taxpayer, and that reconciliation meeting will be such that we have to discuss what are the extra amounts they are going to pay and so on and so forth. All this we have to discuss. And the last thing which I did not put here is a final audit report. Final report, there will be a report that will encapsulate all the activities carried out during the field audit. I hope you are getting me. So please check into your pack. Don't say it's theory. I've actually analyzed it here. Check into your back, and using this graph to look at the content of your pack and look at other details there. So that if I venture the examiner brings something close to this or something related to this in this exam, you have a first-hand information, you have an idea. I hope I get what I'm saying. You have an idea of what the examiner is asking. So it's very important you do that. So that's that. So now that's audit exercise. That's when we carry out tax audits. Now the next thing is tax investigation. Please note, investigation is different from tax audits. When we say you are investigating, there are criminal activities involved. I hope I get what I'm saying now. If the taxpayer is criminally minded and what is even contravening the laws, like is trying to evade tax, then it is not tax audit we are doing in that instance. We are doing tax investigations. Please note, when they say they are doing investigations, then there are criminal activities that have been committed by the taxpayer. Now, what are those things that can lead to tax investigations that can make the tax authority start investigating the taxpayer. I hope you get what I'm saying now. Now, some of those things are when the taxpayer refuses when the taxpayer is paying wrong amount of tax, or using wrong rate of tax to pay, is unduly delaying payment of tax deliberately. We undo delay payment of tax. We have come from his office without due notice to the tax authority, and so on. All these activities that is tantamount to not wanting to pay tax or defrauding the tax authority are what they are captured under the reasons why they will do investigation. Please note, investigation is clearly different from tax audit. Tax audit exercise is normal. They have to do that, but it's on once in a while they carry out investigations when they realize that taxpayer is actually contravening laws and trying to evade tax. And I hope you know the difference between tax evasion and tax avoidance. Please note. So if they are doing a tax investigations, what are those things that they are doing? Now, the focus of tax investigation is to pull the criminal behind behind bars. It's not to ask him to go ahead and make payments or whatever that they do in the tax audit exercise. It is meant to have his day in court, and they deal with him or her. I guess what I'm saying now. So that's more of the tax investigation. What are the stages of tax investigations? If they are doing tax investigations, the stages are: one, there will be pre-investigation activities. I mean, more of the way they did that of the tax audit also, where they need to do preliminary activities, preliminary study of the taxpayer. They need to do preliminary investigation activities. I mean, to look into the files of the taxpayer and other details they can have. They lay their hand regarding the taxpayer. I mean, in relation to that particular fraudulent activities. Now, after they are sure that, because you have to be sure that the person is a thief. You have to be sure that the person is actually contravening. You can't come to my house and tell me that I'm a thief when in the actual fact I'm not a thief. I guess me. So all this prevention activity will be thorough, and they'll be so certain that there have been malfeasance, or they have contravened laws. I mean, because of not wanting to pay tax. So pre-investigation activities. After they are done with that, then they notify him that they are coming for investigations. And after that, they do pre-investigation meeting, the way they had meeting in the course of tax audit. And the pre-investigation meeting, we suppose that they need to tell him and intimate him of the reason why they are there, that it's for investigation and so on. After the pre-investigation meeting, the evidential audit or investigation. Please note, this that they are doing is evidential audit or investigation. This is not just the normal field audit. This one is meant, in fact, they will go there with the security agencies most of the time. I guess what I'm saying now, that will be there. In fact, in the course of doing evidential audit, they can instruct that they should close a particular section of the complaint. They can ensure that the activity should stop for a while. They can ensure that they can seize documents. They can, all evidences that they can use to go against him in court. They will seize, they will take over. In fact, they can even take some of the officials along. I guess what I'm saying, for interrogations. So all these are done. These are what they call evidential audits. Apart from that, after they have done the audit, then they make a case behind it based on all the information they got during the evidential audit. Because of evidential audit, they can use it to make a case against the taxpayer. They can arraign him in court, and because of arraignment in court, it's meant to so that they can have his day in court and they deal with it because of that contravention of law and termination of investigations. All these are what you need to know. Please advise us to go into the tax audit and investigations. Please go and check it. Check tax audits, tax investigations. They are there. I've actually summarized it here. Please note it. What are the objectives? Severally in this question, when they're asking this question, they will ask you, what are the objectives of tax audit? Look at it. I think I omitted that. What are the objectives of tax audit? Why do we carry out tax audit? I think I've explained that the last time. So please check it. They are all there. I guess. And apart from that, they also made mention of what are the list of requirements for documents for tax audit and investigation. If they are coming for tax audit and investigation, what are those things they require you to provide for them in the course of that tax audit? In your pack, they listed what's required by FRS and what's required by SRS. I hope you know what I'm saying. FRS is Federal Inland Revenue Service, while the SRS is State Inland Revenue Service. For FRS, it's audited accounts, management accounts, chart of accounts, year-end financial balance, general ledger, audit adjustment voucher, and so on. All these are what, and that of SRS is also there. Please, I want you to look at it. What are you to ask it? You should be able to write something simple. Thank you for your understanding. So please let me, that is that, please. Now I will crave your indulgence to move into what, to leave merger and acquisitions and go into the after we'll still come back to theoretical. My insights tells me to talk about base erosion and profit shifting. Now, the base erosion and profit shifting, let's move into that. Yes. Now, you know, I told you the last time, in the last class, that both base erosion and profit shifting and taxation of digital economy are actually topics that were there in the last syllabus that were not tested. So what about if either of the two or one of the two, either of the two or the two are tested this time? I guess it should be a plus to you if you have an idea. That's very important. So let us just have a brief idea of what we mean by base erosion and profit shifting. This is 17 minutes, but it's, I mean, the next 15 minutes, let's talk about it. Now, when we say base erosion and profit shifting, there are two words there. The first one is what? We have base erosions. While the second one is what? Is profit shifting. So they call it BEPS. BEPS means base erosion and profit shifting. If you get into exam this time and you hear base erosion and profit shifting, what exactly are the examiner talking about here? What is the focus of this? Of base erosion and profit shifting. Now, the first thing you need to look at is, well, what is base erosions? Then we'll now look at profit shifting. Then we'll now combine the two together. Then we'll now go into explaining more. Now when we say base erosion simply means, look at it, is the use of financial measures and tax planning to reduce the size of the company taxable profit in a country. It means that when a company or a taxpayer is trying to reduce their profits, technically or deliberately reducing their profit, so that they will reduce their tax liability. Because you know the tax you are going to pay is a function of the what? Is a function of your profit. So if one way or the other you have found a way of reducing that profit, then you are technically reducing the tax liability. You are paying your tax burden. Therefore, if an organization is using the financial measures or an approach in such a way that they find a way of reducing their profit in a particular period so that the tax payment will reduce, they will say the company is doing what they call base erosion. Look at it. When you say tax base is what you are taxing, like your income, like assets. Then if you are now eroding it, that's erosion. You are washing away your profit, technically. I guess it now. So if you are doing that, we say we are having a base erosion. But if it is profit shifting simply means involved making payments to other group companies in order to move profit from high tax jurisdictions to lower tax jurisdictions. The focus of profit shifting is that when you are looking at a tax rate differential between two countries in which you are operating in, and you are trying to move your profits you make in a particular country, say for instance Nigeria, you want to now technically move it to Zambia, because the tax rate in Nigeria is high as comparatively to that of Zambia. I hope you're getting that. So if you are doing that, then you are doing what they call profit shifting. So profit shifting is talking about using is a means of moving a profit made in a particular region to another region because of tax rate differentials. I hope you get what I'm saying. Now that is profit shifting. Then if you are now combining the two, they call it BEPS. So in the exam, if the examiner now talks about BEPS, or they call it, say, base erosion and profit shifting, you should be able to let them know that base erosion is when you are using financial measures to erode or to reduce your taxable profits in order to reduce your tax liability. Why the profit shifting is when you are when a company is technically moving the profit they make in a particular region to another region because of tax differentials, tax rate differential. That is basically that's profit shifting. Now, what is the meaning of this? Which companies are more predisposed to carry out this activity? Don't forget, this is a global phenomenon also. It's not just peculiar to Nigeria. It's a global phenomenon. So it simply means that the corporates, those people that are mostly using these techniques to reduce tax liability are multinationals. And multinationals are companies that they have their operations scattered all over the world. I hope you are getting me. They have operations in different countries. So because of that, they are able to carry out what they call base erosion and profit shifting. Look at it. Who are the primary players in base erosion and profit shifting? Now, factors that makes multinational group of companies to take advantage of these tax avoidance techniques are, don't forget, the major players of this base erosion and profit shifting, I said, are the what? Are the multinationals. I guess me. So all these multinationals, they are basically involved in these unwholesome practices. I get me now because obviously they are robbing off the what a particular country. I mean, they are also on their revenue by doing that. Now, what are those factors that would help them or assist them to carry out a successful this activity? I guess even now, what are those factors that would make them to successfully carry out this erosion and profit shifting? These factors are one, their international operation provide a ready-made network of companies through which funds can flow. It means that they are having international operations. I mean, because they are having a network of companies all over the world, so they can successfully move funds from one country to another through that platform. That's one. Two, they have capital to set up and maintain entities used for tax reduction purposes. When they say a company is a multinational, it means that they are wealthy, they have money, they have capital. They have capital that they can use to have a structure that will be used, that they will depend on to carry out these unwholesome practices. So they have capital to set up and maintain companies used for tax reduction purposes. And thirdly, their income tends to be large enough to support the cost of taking advice on tax restructuring. It means that because they have resources that can support employing experts that will assist them in carrying out these unwholesome practices, just because they have the resources, the capital at their disposal. So in the examiner can now ask you what are those factors that makes multinationals to successfully carry out base erosion and profit shifting. So you should be able to tell them that through their network international operations, they have capital to run, and they can also they tend to have large enough to support costs of maintaining structure and put in place and maintaining the recommended tax structures. All these are the factors that presuppose itself. Now, base erosion and profit shifting techniques in the exam, I am 100% sure that if peradventure the examiner comes from this area, they will ask you of these techniques. It's just this area is to be easier for students if you have read it and you want and they ask it, because there is nothing else they want to ask from here than they ask you what is base erosion and profit shifting. What are those factors that predisposes what are the factors that assist in carrying out this base erosion and profit shifting, and also what are the techniques? It has the techniques. Now let's quickly look at those techniques used by the multinationals to carry out this base erosion and profit shifting. Now let's look at this. Base erosion and profit shifting can be achieved using any or combination of the following techniques. Let me, to the best of my knowledge, because the ICANN part did not really expatiate more on these techniques, but let us based on research and other information we also gotten, and let us see how we can explain it in the next 5 minutes. Now, if a multinational wants to carry out a base erosion and profit shifting, one of the techniques is tin capitalization. Tin capitalization. Now, how do you, please, in this list, you don't just say you know the point. You must be able to convince the examiner of how you can, how that thing capitalizes means when they say a company is thinly capitalized, that means that the company is highly So sorry, I'm actually grappling with the network issue, but we just pray that it should stabilize. So sorry, I'm sorry, beyond me. Now, based on what I was discussing the other time, I explained that when you are thinly capitalized, you are having more debt in your capital structure than equity. That means that you are having, that means that you are going to pay more interest than dividend. Now, what's the implication of that? So if a company is thinly capitalized, that simply means that more interest will eat the account expense and it will drop the profit and drop the tax payment. As against if the company is lowly capitalized, lowly geared, that means that it's having more equity than debt. In that instance, dividend on equity is not an allowable expense for tax purpose. Therefore, if a company is highly thinly capitalized, that simply means that that company will be paying more interest and the tax liability will reduce. Now, the multinationals now they have that understanding and they will tap into that by finding a way of reducing their tax liability by trying to get thinly capitalized. They will try as much as possible to be highly geared, and not only highly geared. Now, the implication of it is that let me even first go through what they have here so that I can now buttress it quickly. Now, the multinationals can set up a subsidiary with minimum share capital. They can now use another subsidiary. It means that if we have a multinationals now, and that multinationals is having a what an operations is having a what a business operation in Nigeria, and they're also having a what in Ghana. Now, it's possible that they can if they want to reduce their tax liability in Nigeria, what they would do is that their company in Nigeria, they will ensure that that company is highly geared. But I mean, it means that it will have low equity, but to have more debt. Now, don't forget that debt now, they will assume, or they will design it in such a way that debt, they will say that debt they transfer the debt from where? From their Ghana center. I hope you get what I'm saying now. Now they can make that Ghana operations to be a financing arm. When they say financing arm, the financing arm in the sense that from that Ghana, they will say the loan or the debt that the one in Nigeria is using to run their operations are actually coming from Ghana. Meanwhile, both Ghana operation and Nigeria operation, they are the owner. So the debt that is coming from From Ghana now, coming to Nigeria now, will make Nigeria to be more geared, and it means are more thinly capitalized. Now, because of that, Nigerian operation now, Nigerian arm now is now thinly capitalized now. They are having more debt than equity, which simply means that in the operation in Nigeria, whenever they make profits in Nigeria, before they make the profits, the interest element will be so high because they are highly thinly capitalized. That interest element will drastically reduce the profit they make in Nigeria. I hope you are getting me now. And as it's reducing it, it means that technically they are eroding the base. That means that base erosion, because they are technically reducing profits through the interest. Now, not only that, now when they are now paying that interest, they have used the interest to reduce the profits because they are going to pay it to the person that supplied, the company that supplied them the interest, the debt. Now, as I'm paying that debt, now paying the interest, they are paying it back to Ghana, and the Ghana is still their company also, because the Ghana happens to be the one that financed that debt, financed the one Nigeria's own with that debt. So it means that interest now will now return back to their company in Ghana. So as Ghana operation is receiving the money, it's become an income in their hand. And as it's the income in their hand, what happened? They will tax it in Ghana, and they will now pay the tax in Ghana. Can you now see a profit shift now? It means that they are technically moving the profits that should have been taxed in Nigeria. They moved it to where? To Ghana. So that what? So that instead of it being taxed in Nigeria, they use that thin capitalization towards to move that profit in form of interest towards Ghana. And Ghana will now tax it because it will now be an income in the hands of what? Of that operation in Ghana. And it will now go into the coffers of what? Of the Ghanaian government. And you now see a profit shifting now. That means that multinationals can use thin capitalizations to do base erosion and also at the same time do profit shifting. Base erosion in terms of using the interest element to reduce what? To reduce their profit in Nigeria so that they will reduce their tax liability, which is technically a base erosion. And at the same time, moving that profit they ought to tax Nigeria to other countries in form of what? Of interest or what? On debt. That is what profit or profit shifting. That is one technique. Please explain like that for them in the exam. You will understand. The next one is technology and what? And trademark and technology licensing. That's another technique highlighted by the World Biopower. I guess it as a means of doing base erosion and profit shifting. If you look at it, let's look at what they put it. They said the multinational can decide to use an entity in the group. Let's say, for instance, we have a multinational that is having like 3 entities in their group, one in Nigeria, one in US, one in Ghana. Now they can now spot the one in Ghana, and that's okay. The one in Ghana will now be the one to manage the trademark. I mean the brand name, the trademark of the company on behalf of others. I guess other entity. I guess now. So it simply means that trademark and technology license, the multinational can decide to use a company or an entity in the group to manage the trademark design and patent. You'll be the one to what? To be in charge of what? Of management of the trademark, the patent, and so on of the whole company. It means that as in managing it, there are costs incurred. Now, technically, which can arbitrarily, now that cost now will now be spread to other entities that are under the group. Now, the way they will now use this trademark now, cost, to now reduce tax payments in Nigeria, is that they can arbitrarily share it so that they can use it in achieving their purpose. Because if the total amount is 1 billion, 100 million, and they are able to tell us that the one that is ascribed to what to Nigerian entity is 80 million out of 100 million, while the US and Ghana will have 10 million. So that means that 80 million will come into Nigeria, in Nigerian operation as an expense. It will eat the account, reduce the profit, reduce the tax liability. That means that if you look at it, that means that they're already doing base erosion. Because if you look at it, they can decide to use an entity in the group to manage the trademark design and patent, which can arbitrarily, that entity now, that a particular entity now, can now arbitrarily charge the group companies down, the other one under the group. The royalties on the use of the what ought to be achieved. The objective will be such that that entity that is managing that trademark can now technically share it. Can now technically share it in such a way that they will push more of that trademark cost into the Nigerian entity, which will reduce the profit in Nigeria and reduce the tax liability to Nigerian entity. That's the second one. The second technique. The third technique is hybrid mismatch arrangement. Now, I want you to listen carefully to the hybrid mismatch arrangement. So there are a lot of English, there are a lot of story they put around it. But let me dissect it for your understanding. When they say hybrid mismatch arrangement, it means that you are trying to mismatch two things. You are trying to mismatch in the sense that, let's say, for instance, the first instance we cited the other time that they have operation, the multinational have operation in Ghana and in Nigeria. Now, if peradventure the operation in Ghana, that company they have in Ghana, if he decided to invest in Nigeria, and in the course of investing in that Nigerian company under the same group, now they will assume, the one in Ghana will assume that investment is making in Nigerian territory. They are the one doing it, so they are technically working on the cycle of the tax authority. They will now say that investment, they will take it as if they are buying shares in that company. I guess what I'm saying now. That they are buying shares. The one in the other side is buying shares. That money is investing in this one in Nigeria is as if it's buying shares. That's more of a is what is buying shares. So you were entitled to what? To dividend. Now that money now, when it gets to the Nigerian company, the Nigerian arm, that Nigerian arm will not see that money, that share, that investment. They will not see it as what as shares. We will see it as what as just ordinary investment. I mean, other investments that's what you need to pay interest on and all that. You need to pay interest on and all that. Can you now see two entities are seeing the same transaction differently? The one in Ghana that is doing the investment will be looking at it from the angle of what of shares. The one in Nigeria will be looking at it as an angle of what of investment in terms of what of debt. Now, the one in Nigeria now, after they make profits using the money, now that's they will now, they'll pay interest. That interest now, it will not hit the account of Nigerian company. It will reduce their profits and reduce their tax liability. Can you see there is base erosion and profit shifting? There's a base erosion, I mean, because they have reduced the profits and reduced the tax. Now, if that interest now, when they now eventually paid it to the Ghana now, what will it do? The Ghana will what? We see it as what? As a dividend. And it is possible that in Ghana, they would have studied it very well, that in Ghana, any dividend received will be tax exempt. They would have studied that company that in their law over there, when they receive something like dividend from another country, it will be what? It will be a tax exempt. That means that it will not form part of their income for tax purpose. Therefore, when they get to Ghana now, the same company, the Ghana arm, that Ghana now, they would not add it to their income for tax purpose. That means that they will not pay tax again on it in Ghana. Can you now see one transaction they used to escape tax in Nigeria significantly using through interest element, and they also use it to dodge tax in Ghana again by not including income because of the law of Ghana. That means that you call that double non-taxations. That simply means that they are using that transaction to dodge taxes. That is also base erosion. I guess what I'm saying now. That is what they mean by hybrid mismatch arrangement. It means that you are mismatching two things. That particular transaction is used to reduce tax liability via interest in Nigeria. And the same transaction is also used to reduce tax liability via tax exempt in Ghana. That is double non-taxation. It's also another way of their activities. In base erosion. So quickly, if you check what they put in, it's a hybrid mismatch arrangement. Multinationals can explore the differences. Can you see? They can explore the differences in tax rules between countries to achieve double non-taxations. For the aim of reducing tax burden, this applies to treatment of certain instruments as tax deductible debt. That's interest deductible debt in the paying country. That's Nigeria that is paying that money. The interest is reducing the profit, and seen as a tax exempt income in the receiving country in Ghana now. As they are receiving it, is a tax exempt over there because they have studied the rules in the two countries and they have used the rule to draw tax in two countries, which is called double non-taxation. So double non-taxation. That's that. Explain to them that in the exam. The last one there, the last technique there is what is they said putting assets into entity without substance. I tried to decipher what they're trying to say here to the best of my knowledge because they did not expatiate on it in the material. But they said putting assets into entity without substance. Some countries introduce preferential tax regimes as a way to compete for businesses. That means that, let's say, for instance, we have Ghana and Nigeria now. Obviously, in these countries, they will be competing for businesses, for FDI, foreign direct investment, so that what people will be coming, companies will be coming into their countries. Now, how do they attract these people? They'll give them generous for tax incentives. I guess what I'm saying that so that they can attract these companies. Now, if they did any generous tax incentives, ordinarily, that ordinarily is what is eroding the base. Because if they give a tax incentives, then a base is eroded, and that is understandable. Because the money that's supposed to come into the hands of what? Of those countries, I mean, of the tax authority would have reduced because of that incentive giving so that they can attract these companies. Now, that technically means that we are hoping that if this company come into our region, they will start producing, they will start employing, and that money will start coming in, and that tax that we are given, that's incentive we are given in terms of what at the initial stage, we start coming back in form of what is going to receipt from payee and so on. But they have eroded the base already. But most of these companies that are coming, it's possible that these companies are what? They are just a paper company. And when I say a paper company, they are fictitious company, that their functions, their role is not just to be productive in your country, but to come in to enjoy the the benefits of that tax incentives. And at the end of the day, they will not be productive. I guess they will move away again into other countries after they have actually enjoyed those benefits. That's technically, you are giving them incentives. That incentives you are giving them have eroded your base. At the end of the day, you see these companies not being productive as you expect of them. That simply means that they are what? We're saying you are putting assets into entity without substance, into companies without substance. Company without substance, you're putting assets into it. Look at the way they put it. I copied your material about it. They said, some countries introduce preferential tax regimes as a way of competing for business. However, this is only useful if these businesses with substance begin to locate themselves in the country. That is, it will only be useful if you're giving that incentives. If those businesses that have been attracted are with substance, are what are good, they are good to go. But in the country, otherwise, if not, this form of tax competition simply erode the tax base. That incentive you give, it erode the tax base. If those companies are not meant to come into the country to be productive, erode the tax base of the country where the activity takes place. It means that if there are companies that are not meant to, what are not having substance, but you are actually giving them generous incentives, at the end of the day, realize that what instead of what to add up to the GDP and the system so that they can have more returns in terms of tax returns, you realize that what they are not just doing that. I hope you are getting it. So that simply means that can also be a means of reducing the tax base. I hope you are getting that, of reducing the income coming to the government. So that's more of us. Please note it. Now they ask us what are the OECD actions to address this issue of BEPS. Now I want us to look through these OECD actions in taking care of this BEPS. When we say OECD, that's Organization for Economic Cooperation and Development. That's the was and actions that they have marshaled out, that they said they should use to take care of this menace of what of the multinational in terms of this evasion and profit shifting. Let me just take the one that are easy to decipher. Let me take the second one. Require taxpayers to disclose their aggressive tax planning arrangement. What does that mean? If they require taxpayers to disclose their aggressive tax planning arrangement, that is, develop recommendation regarding design of mandatory disclosure rules for aggressive or abusive transactions arrangements or structures, taking into consideration the administrative cost of tax administrations. Now, the meaning of this required taxpayers to disclose their aggressive tax planning arrangement is that OECD mandated and OECD advised countries that if they have multinationals operating in their territory, they should ask them to disclose their aggressive tax planning arrangement. Let us know your tax plan. If the way you have been preparing your tax, or you have arranging your tax, you have been doing your tax arrangement is such a way that is ensuring that you are not paying tax, or you're paying as little as possible. I get it. And they say that it's too harsh. It's too harsh as to not want to pay tax to government. he said they should ask them to disclose their tax planning, aggressive tax planning arrangement. So if it's too hard, they can ask them to revise it. I get it now, so that they will not it will not affect their tax returns. That's that. The next one I want to talk about that is a bit. Now another one is re-examine transfer pricing documentations. I hope you know the meaning of transfer pricing. Transfer pricing is what? Transfer pricing is the price at which group multinational transfer goods from one unit to another. I hope you understand what I'm saying. The multinationals can transfer goods from one of their goods from another country to another country. And if they are doing that transfer, the price at which they do the transfer intra-company now is what is what we call transfer price. Transfer price. Now, if they are doing this transfer price, they can use the transfer price to also reduce tax liability in the country of choice. I hope you're getting me. So one of the suggestions of the OECD is that what that they should re-examine transfer pricing documentation. That is, they should develop rules regarding transfer pricing documentations. It means that the way these companies are transferring within the crew should be looked into in such a way that if it's making them to dodge tax or to do base erosion and profit shifting, then they should quickly address it. The next one is what? Make dispute resolution mechanism more effective. It means that if there are disputes between two countries in which a multinational is operating, these multinationals can tap into these loopholes to their own advantage. Say, for instance, we have two countries in which a particular multinational is operating, and there is no consensus between these two countries about the way they treat a particular transactions. Now, these multinationals have a role of looking into that disconnect between the two countries and leveraging on that disconnect to their own advantage. Therefore, there should be if there is any dispute between two countries regarding treaties and so on, they should quickly resolve it. That's solving treaty-related disputes. Can you see? Solving treaty-related disputes. Make dispute resolution mechanism more effective. That is, develop solutions to address obstacles that prevent countries from solving treaty-related disputes under mutual agreement procedures. I hope you are getting it now. So that multinationals will not tap into these disputes for their own advantage. Another one is what? Another OECD suggestion is to address the tax challenges. Look at it. Address the tax challenges. Address the tax challenges of the digital economy. You know, I've explained digital economy, the tax challenges. Can you now see the two are connected? That's more of the reason why I say they can drop any of it. Address the tax challenges of digital economy, because digital economy can also make multinationals to also carry out this activity of BAPS and so on. Neutralize the effect of hybrid mismatch arrangement. You know, one of the techniques of doing base erosion and profit shifting is hybrid mismatch arrangement. When I talked about dividend and interest the other time, then it simply means that so far the multinationals are using one transaction to dodge tax in the two countries. Then OECD is now saying that they should knock off one of that privilege. If they have escaped tax through interest elements here, then when they get to the other country, that other country should not make that income to be tax exempt. Rather, they should be taxable. I hope I get it. With that, they must have successfully used it to reduce tax in Nigeria through finance charge or interest elements. But when it now gets to other side, they should not make it a tax exempt. Rather, it should be taxable. All this are what we mean by the rules. So they listed 15 in your pack. If they are coming here, I go and look at the open-ended questions. They said, explain the concept of base erosion and profit shifting. That's one. List and explain the techniques of base erosion and profit shifting. That's two. Why the third one is what? List at least 6 or 7 recommendations of OECD regarding the tackling of the menace of base erosion and profit shifting. Those are the ones that will be the thing that they will ask here if the examiner actually comes out from here. Now, so this is regional integration. So this one you can let us just go straight to the company income tax first before important. Read them, very important. Now, if you look at it, if you look at it, let us now look at basis of assessing companies to tax. Now, because of the constraint of time we have, so let us see what exactly can we pick out from this basis of assessing companies to tax. Now, this goes to the fundamentals of what of the company income tax in Nigeria now, because the way company is being assessed to tax is critical, and that's what is mostly affected by the Finance Act. I hope you know that we have a Finance Act now. One was signed in 2019, another one was signed in 2020. The one that was signed in 2019 was actually meant for 2020 year of assessment, while the one that was signed in 2020 was meant for 2021 year of assessment. Hope you are getting me. Now, those Finance Acts, the Finance Act are meant to overhaul the existing tax laws. Hope you are getting me. And they say about 80 recommendations were made in that, as much as 80 recommendations were made in that act. So, but how is it affecting us? Our own is to look at what is the direct impact of that Finance Act. You can know all for now, but how is it affecting your advanced tax in exam, and how can you use it to move to the next level? I get it. So your concern is to note for your exam so that you can get the future, because you know this is the accounting period which is related to any particular assessment year. All chargeable profit income falling within this period will be taxed in a particular year of assessment. That now makes sense. Now let me sound this. Majority of the students, what normally face student in the exam is their inability to differentiate between year of assessment, ability to differentiate between year and the basis period. Two different things. The year of assessment is the year where you are paying the tax to government. Why the basis period is what is the period in time in which the profit of that period is what you want to tax in the year of assessment. I get it now. That period, from what period to what period profits do you want to tax in a particular year of assessment? That period, that interval of that period in which the profits you're going to tax in the year of assessment is the basis period. I get what I'm saying now. And that period is supposed to be 12 months. I hope you're getting it. Depends on the year of assessment of the company, but it should be 12 months. Why the year of assessment is the government year. And it's always 12 months also, starting from January 1st to 31st December of a given year. Therefore, the way the tax company in Nigeria is through preceding year basis. Preceding year in the sense that they will allow you to have finished making your profits. Then a year after that, which you have made the profit, is when you pay tax to government. So if my profits, I made it between January to December 2021. That simply means that January to December of 2020 is the year of assessment, is the basis period. Why 2021 is when that profit of that basis period will be subject to tax. That is understandable. That means that every basis period must be 12 months. That is what we call a normal basis period. But there are some instances in which that basis period, you know why it's going to be 12 months? It's going to be 12 months because if it is 12 months, the government year, when they're going to tax them, is also going to be 12 months. But that government year is always starting from January to December of that particular year. So 12 months basis period, 12 months year of assessment, that's okay. But there are instances in which that 12 months of basis period will not be up to 12 months or even be more than 12 months. I get it. What are the reasons why you can have less or more than 12 months in basis period? Why is it that it will not be equal to 12 months in basis period? I hope you get what I'm saying now. That basis now is what we are now trying to talk about now. That business what we can have, and that business are what can be due commencement, when you are commencing, when you are ceasing, and when you are changing your accounting date. I hope you are following now. Now the normal basis period is made up of 12 months. It will start immediately the previous year's basis period end. I hope you're getting that now. That is normal basis period. it will be 12 months, which is start from when the previous one ended. If the previous one ended in December 31st, 2020, the next basis period will start on 1st of January 2021, and so on like that. That's more 12 months. But if it is less than 12 months or more than 12 months, what's the reason? It can be due to business newly commencing, seizing the business, and also when they are changing their accounting. Now, our concern now, let me state this, because let me state this categorically, that in this exam, you need to study the dates given. If the examiner is not explicit of what you should use, whether the New Finance Act or not, though you should use the information on the New Finance Act in this exam. But if you look at the frame of the material of the ICANN pack, you realize that in your ICANN pack, there are some topics in which the examiners still use the old rules. I guess going by the dates they use in that questions. Like, for example, in your pioneer legislation in your ICANN pack, they use the old rules, old commencement and cessation rule in that pioneer legislation. So it simply means that it's neither end of that. Examiner can still revert and still ask questions that will involve you to use your old old rule of a taxing company. I get what I'm saying now. So I will advise you to know both old and what and the new. But mostly we are using New Finance Act, and the new should suffice. But what about if those dates were given at 2001, 99, far away from those periods where they signed this new act? Are you not going to use the old route? Are you going to use the new route? No, you have to go by the old route. So it means that from my own view now, I think students should be very careful in the exam when you are picking when you are doing the exam, and you make relevant assumptions, talk to them what you are doing, they are reading old rules, what you are doing, and all that. That is if the examiner is vague, if they are not explicit as to the direction of the questions. So therefore, I will need to look at it, the rule for dealing with basis period on commencement now and basis period on cessation were both revised in the new act. They changed our rule of commencement and cessation. Why that of the change of accounting date remain the same. Let's look at it. Let's look at the rules of determining basis period before the New Finance Act. Let's look at the old rule. Now, let's quickly look at it. If the old rule of what, when a company is commencing, look at its commencement of business, that's before the New Finance Act. How do they tax a company that is newly commencing? Now, what is very important for you to know is that the first 3 years of operation of that business, the first 3 years starting from the year of commencement and the next 2 years immediately after the year of commencement, it rewards that the way they design them differ from how it is in the New Finance Act now. Let's look at the rules in the old rule. Now, in the old rule, look at it, for the first year, assessable profit shall be the profit from the date of commencement to the what? To December 31st of that particular year. That means 2012. Then that my first year will run from the basis period will run from 1st of March 2012 to 31st of December 2012. I hope that is clear. That is for the first year. I'm using the old rule now before I go to New Finance Act. The second year will now be the assessable profit shall be the profit from the date in which the company commences again. That's 1st of March 2012 to the next 1 year, to the next 12 months. You count it again. Can you now see there is an overlapping now? Because the first year also commences from the date of commencement to December 31st of that year. But the second year also will commence from the date of commencement to the next 12 months. That is understandable. So the profit to make that in that period is what you tax. Don't forget, in the first year, the year of assessment is our first year. So from 1st of March 2012 to 31st of December 2012, then the year of assessment of that profit will be 2012. In the second year, which is 2013, the year of assessment is 2013, and the basis period will start from 1st of March 2012 towards to 30, towards to 1st of January, 1st of 31st of 20th of February 2013. That means that you are running from March this year to February next year. That's another 12 months. I hope I get what I'm saying. So that's the 12 months from date of commencement. That will be the second year. Now, the third year is, for the third year, the assessable profit shall be that profit of 12 months ending in the accounting year end. In the accounting year end of the year preceding the third year. You know, the first year is 2012, second year 2013, third year is 2014. That year of assessment 2014, what is preceding it? 2013 is preceding it. It means that 12 months that will end in the accounting year end of the company. They will tell you the accounting year end of the company. You will now read it up to accounting year end of the company in 2013, which is what preceded 2014 year of assessment. All this work to be taken care of in what's in our illustrations now, so that it will not be just the abstract. Know that the taxpayer has the right of elections. You know, there is right of elections at commencement in the whole group. Let's look at this. Let's quickly use this to what to illustrate and have it. Because why I'm doing this is because of the what is the pioneer legislations. Go and check your pack. The examiners use this old rule. So I don't want to rule it out that they cannot use it again. Hope you're getting it. It's very important. Now look at it. They cannot, you can still use it. It's very important. Just monitor the date you are given in that question. Now, ABC Limited commenced business on 1st of March 2014. This happened to be the date of commencement now, March 2014, and makes up his account to November 30 each year. That's the accounting year end, November 30. Now, you now say you can determine the basis period for the first 4 years of assessment. Now, the first 4 years of assessment of the business, what is the basis period and what is the year of assessment? If you look at it, so far we are starting from 1st of March 2014. You run it from that day to December that year. That is, for the first year, the basis period will be 1st of March 2014 to December of that year. What is the year of, when are you going to pay that? What is the year of assessment? In 2014, they will do the year of assessment. Now, in the second year now, you also start from the date of commencement of the business. I mean, this is this 1/3/2014. You now run it for the next 1 year. The next 1 year will end in what, in February of next year of 2015. That means that the profit you make during this period, this 1 year, starting from commencement date, will be taxed in what, in 2015. That's the year after 2014, 2015. While the third year will now be 12-month period that will end in this November. And it will end in a preceding year of this 2016. What is preceding 2016? It is 2015. 2015 will precede 2016. Therefore, you need to look for a whole 12-month period. That 12-month period will be ending in that November of 2015, which is preceding 2016 year of assessment. Look at it. This 30/11/2015, that's the accounting year end. 2015 is preceding 2016. Right? So when will it be starting from? From 1st of December last year, 2014. But this is a whole 12 months that is ending in this accounting year end, which is 11 November, of what? Of the preceding year of this 2016. That means that the profit they made, don't forget, if after you have looked for that 12-month period, like the way you look for it then in third year, and it happens that the beginning year happens to be 1st of February or 1st of what? Of January 2014. After you have done this analysis there, assuming it's 1st of January or 1st of February you are commencing with, then you will now look at it that this business commenced in 1st of January or 1st of February. No, they commenced in 1st of March. Therefore, if a scenario that they created for you in the exam is supposes that this 1st of this period here will be 1st of January or 1st of February of 2014, you will knock off this basis period. What do? Because they have not commenced business in 1st of January or 1st of February of 2014. They commence in this period. Therefore, if you have that scenario, then you need to repeat what you have in 2nd year in the 3rd year. So you just remove what you have here in 3rd year and replace it with what you have in 2nd year. That happens to be the basis period using the word old rule. And if you look at it again, what about the right of elections? Look at the right of elections. The taxpayer have the right of elections at this point. What's the right of election? It means that in the 2nd and 3rd year, he has the right of being assessed to that on actual year basis. You know, what we have been doing here, it happens to be on preceding year basis. Preceding in the sense that 2016, 15 preceded it. But if the taxpayer is now choosing the right of election to be for the 2nd and 3rd year, which is 2015 2016, it will ask them that the right of election presupposes that the basis period will now start from 1st of January 2015, 1st of January to December of that particular year of assessment. It will not be preceding now. 2016, 1/1/2016 to 31/12/2016. I guess this is right of elections. So any profit you make in these 2 years now, based on this right of election, add it together. You also go to the normal one you have determined. Anything you made in this 2nd and 3rd year for the normal computation, add it together. Now, the implication is that if these additions here is more than the additions here, I hope you're getting me now. Then, so far the taxpayer is one that has the right of election. They will choose the lower because nobody will be asked to pay tax and want to pay the maximum tax. We want to pay the minimum tax. Therefore, we will choose the lower of the worst of the two. Don't forget, you must have aggregated the profit of system, added together. The lower of the two is what the taxpayer will go for. If the right of elections one is lower than that of the normal one, then you go for the right of elections. However, that happens to be for the old rule. Look at it. It happens to be for the old rule. This is the old rule. They can ask us. Now, technically, if you are using figures to illustrate that, they say Aboniki Nigeria Limited was incorporated on 1st of August 2014. Please note, when you incorporate on 1st of August 2014, incorporation is irrelevant. What is relevant in computation is what is commencement. I get it. Irrespective of when they incorporate the company, when they commence the company is what's relevant for the computation, either in PPT or wherever, commencement. But due to the logistic issue, the company did not commence operation until 1st of April 2015. They now commence operation on this 1st of April 2015. And the company accounting year end is what is 30th September annually. That means that this is a commencing business also. They now give us the profit they made as at 30th September 2016, 17 to 19, and these are the profits. And they now say you are required to what? To calculate, to compute the assessable profit for the relevant years of assessment using the old rule. Now look at it. Using that old rule now, you now say year of assessment basis period. If you look at it now, in the comments of 1st of April 2015, look at the way we explain it. We say 1st of April 2015 to December 2015. Year of assessment is what? Is 2015. 2nd year, we also start from 1st of April 2015 to the next 1 year, which is 31st of March 2016. That's 2016 year of assessment. While 2017 will be 12 months period that is ending in accounting year end. And what's the accounting year end there? September. Every September. That means every September that is ending in the year before 2017. And that's 2016. Now say 39, 2016. Starting from 1st of December 2015. This is a whole 12 months that is ending in 2016 and is ending in September, which happens to be the accounting year end. They now prorated the profit. If you look at this profit here to September 2016, you know, it will run from the commencement date. Commencement is 1st of April 2015. If you run from 1st of April 2015 to December 2015, that will give you what? 9 months. Is it not? April to December, 9 months. Then, if you now look at it, and you know that it's ending in September 2016 now, 9 plus 9, I think that's 18. because from January to September is 9 months again. So if you start from April 2015 to 30th September 2016, automatically this profit of 12.5 million was meant for what? 18 months. Because if you count the date from April 2015, which is commencement date, to the first end of accounting year end, it gives you what? How many? It gives you how many more? 18 months. That means that this 12.5 million is for 18 months. I hope you're getting me. Why other ones are for 12 months? Because as this one is ending, this one is beginning. This one is ending, this one is beginning. These are 12 months. Therefore, the first one is 18 months. What do? You now go into that basis period in which was highlighted. Look at the basis period that has been highlighted. You now see from this 1st of April 2015 to 20 December 2015, how many months is that? That's 9 months. Then you now be 9 over that 18, because it will now fall into this profit, 12.5 million. Now say 9 over 18 times 12.5 million. That will give you what? That will give you what? Your answer. I hope I get what I'm saying now. Oh, unfortunately, this person did not put it as, person that has to type did not put the answer there. I'm sorry. So you just need to compute and get the answer. Now in 2016 year of assessment, you also start from 1st of what? Of the same day or the same month of 2015 to the next 1 year, which is 31st of March 2016. How many months is that? This is 12 months. That will be 12 out of the 18 months again. Times 12.5 million. Because if you look at it very well, you see this first accounting year end is 30th September 2016. And this also end 30th, and this is ending in 30th March 2016. So starting from what? From date of commencement. And that date of commencement was what? Was April. So from April to March is 12 months. So that's 12 over 18 times 12.5 million. Don't forget again that the last year is also 12 months. So that 12 months again can also be seen in that 12.5 million. 12 over 18 times 12.5 million. All these are what you need to. This is the right of election. This is what the computations. Now, okay, Zeros of me ask questions. That so far a company classification or something is a new business that just commenced business won't pay tax for the next 4 years. No, all business will pay tax for the next 4 years. Basically, it is a minimum tax that they will not be entitled to. I hope I get what I'm saying now. It simply means that if a business is within 4 years of operations, then obviously they will not be entitled to the minimum tax. And also if they are within the first 4 years of their calendar, I guess you mean. And also if a company is I think agro-allied and so on, within the 4 years of operations, I think the minimum tax issue will not come up and all that. But if a company is newly commencing, nothing is stopping the company from not paying tax. No. But the only thing that will make them not to pay tax is more of if that company is not reaching the threshold of turnover. I get you now. You know, there are threshold of turnover that you must meet that will classify you, that will not make you to be a small company, that will make you to be a medium or a big company. So if you're still meeting that threshold, I hope you're getting me, then you should pay tax to government. But if that threshold, based on the new finance act, if that threshold is not met, if you did not make it up to 25 million naira, then as what's in turnover anyway, then they will assume you are a small company. So far you are a small company, you will just need to file your returns to government, and you will not be what? As you're filing your returns, you will not be paying tax, and you will not even pay minimum tax to government. Hopefully that's what I'm saying, because you are a small company. But even if you are starting business and you are making profit and you are making sales that is more than that threshold, then you are required to pay tax. So let me just continue. Please, can you give me just 1 minute and to ease myself? Just 1 minute and to ease myself, please. Yeah, please, thank you. Yeah. Let me just ease myself just 1 minute, please. I'll be back, please. Thank you. Okay, thank you. Oh, my host. Okay, thank you. Thank you. Now, let's quickly run through this. Now, we are still looking at that right of elections which are done. So please we check it and just monitor the movements. The right of elections will be second and third year, 2016 and 2017. If you look at it. For 2016, it will start from 1st of January 2016, that's 1st of December 2016. And for 2017, it will start from 1st of January 2017 to 31st December 2017. So that means that now for this is 9/8, 9/12, and that's what the profit. So please note it. This is way to go about it. You want, if sure it mandates you or require you to revert back to the old rules, please check it, revise it before you go ahead, before you go into the exam, or at least for knowledge sake. Now, but if in the commencement of business using the new Finance Act now in the new Finance Act now they now change the way in which this business period have been determined. And the reason why they changed it was because they tried to remove the issue of overlapping of business period and a gap in business period. Okay, the meaning of overlapping of business period is more of when we say you commence business on March, 1st of March 2015. The first accounting year will now be 1st of March 2015 plus 1st of December 2015. The second accounting year again will start from 1st of March again, 2015 to the next 12 months, which means that 1st of March to December of that year is common to the 2 years. That is an overlapping. It means that you are taxing the same income twice. So the reasons for this new Finance Act in this aspect is to remove that doubling of, to remove that overlapping of the basis period. That is what we actually look at it. The rules of determining the basis period using the new Finance Act now. The assessable profit of any company from any trade or business for its first year of assessment and the 2 following years of assessment shall be ascertained in accordance. Look at the way the new act now say we should do. In the first year, Okay, let's look at it. Sorry for the network issue. Now, as I was saying, for the first year, their same profit shall be the profit from the date in which it commenced to carry on such trade or business in Nigeria. To where? To carry on business of Nigeria to the first accounting, end of the first accounting period. Can you now see it's now a bit different from the one we are used to? It's a bit different from the one we are used to, because if you look at it, okay, because if you look at it very well, if we commenced on 1st of March 2020, let's assume, and the accounting year end is every August, that means that the first accounting year now will be basis period now will be 1st of March to 31st of August of that same year. It will not be to 31st of December. Please note it. It means that it will carry on such trade or business in Nigeria to the end of its first accounting period. So first accounting period is what? Accounting year end. You will use December for the first year. You run it to the accounting year end. That's that. B, the second one, the second year. For the second year, the assessable profit shall now be the profit for the first, from the first day after its first accounting year period. It means that at the end of that first accounting year period, a day after it, to the next accounting year period, making 1 year again. I get it. From the first day after his first accounting year period to the end of the second accounting year period. Then the third year will now also be from the end of that to the next year accounting year end. The next one for the end of that to the next accounting year. Can you now see? That means that in this scenario now, there will not be any issue of overlapping whatsoever. So no overlapping. Look at it now. This is what the examiner is actually telling you to do. That XYZ Limited commenced business on April 1, 2020. It means they commenced business on April 1, 2020. You can now say I'm using those dates of the new date now, of the recent date now. April 1, 2020, and makes up account to November 30th each year. Look at it too. It means that I commence on April 1, 2020. Look at it. April 1, they now say determine the basis period for the first 4 years of what? Of assessment. In the first year now, under the new rule now, it will start from the date to commence to the end of the accounting year. You know, before in the old rule, it will be to December 31st, 2020. No, it won't be now. You now need to go and check what is the accounting year end of the company every year. It's every November 30th. That means that the first basis period now will be from 1st of what? Of April 2020 to 30th 11, which is November 2020. Can you now see what will now be the year of assessment of this? The year of assessment will be the next year, which is 2021. It won't be that year again, unlike the old rule. You know, the old rule would have been that 2020. No, the new rule is what? 2021, a year after. Now look at the next year now. When is this one ending? 30/11/2020. What's the day after it? 1st of December 2020, right? That is when the next year basis period will start. 1st of December 2020 to 30th 11/2021. What's the year of assessment? A year after this is 2022, the preceding year. If you look at the third year, it will start from where this one ended. 1st of December 2021 to 30th 11/2022. The year after the 22 is 23 again. Now you now see the way we move it. Do we see any overlapping here? No, because as one is ending, the other one is starting. As one is ending, the other one is starting. Unlike the old rule, in which this one will automatically terminate in December, the first year. While the second one will also start from where the first one started and also terminate in what? In the next 12 months. But in this instance, there is nothing like that. That's why this is more convenient. I guess like there is no overlapping of the rule. So you need to know that the Finance Act actually affected the commencement of business and the cessation of business. But change of accounting dates now is not affected because the way it was in the old one, the same way it is now. I hope I get what I'm saying now. So you need to note that. Now, that's what I'm saying, Abiola. I said we don't know the direction of the question, how they are going to say the question. There was no pronouncement regarding that. I would have not even asked the student to even look at the OJU, assuming I did not see the pioneer legislations that they use the OJU in it. You check your park, you see it. They still use those commencements, OJUs, and so on in that pioneer legislation. So that presupposes that they can still feature that OJU because we are doing the exam and it's the exam and there's nothing you want to do about it. If in their own ICANN park, they have what they have that, then it means that you should just on the sideline, try to have an idea of it. I mean, just try to put that old rule in your head, but concentrate on new rule, but have an idea of the old rule. So that when you get to exam, at least whichever the case, you are good. Okay, that's it. Now, the next thing we need to now look at is what is cessation of what of trade. Under the cessation of trade, in the old rule, we always talk about what do we not always talk about? Penultimate and ultimate year. It means that cessation simply means when a business is what is stopping completely. I hope you get what I'm saying now. When a business is stopping, what is the position of what of tax law? Totally ignored. It's ignored. The right of election is ignored. Exactly. Because there is no overlapping or the gap in the right in what in the new rule. I get it now. Yeah. So now, if you look at it, the implication of the what of this old rule now. In the old rule, we use what we talk about penultimate and ultimate here. Now, if you check it very well, now in the look at it, the last year of operations, which is ultimate year, and the year immediately before the ultimate year, which is penultimate year, are very important in what is when a business ceases and how to tax them. Now, in the old way of doing it, for the ultimate year, that's the year they cease. As they said they cease in March 2015. That 2015 happens to be the ultimate year. That's the last year of the business. Then it means that the basis period for that last year will run from 1st of January of that year till the date you cease the business. Till the date the business cease. That's what happened in the ultimate year. If you look at it for the ultimate year, its basis period shall be the period from the 1st of January of the year of cessation to the what to that date of cessation. It will now be 1st of January to 31st of December of March, 31st of March of that particular year, if March happens to be the year of cessation. That simply means that what it's like that. So that's for cessation. But what about the penultimate year? That's a year immediately before the year of cessation. That means that that instance we need to consider the what they call what you can either what do that either on preceding year basis or what actual year basis. That's look at it for the penultimate year, it shall be under either it shall be on either actual year basis or what on preceding year basis. The one that gives you what the higher profit will be chosen by the tax authority because as cesations is the tax authority that determine is the tax authority that will choose as cesations. But at commencement is what is the taxpayer that will choose how to be taxed. So that happens to be for the whole rule. Now look at it. Illustration 4. Let us look at this illustration 4. Now, not minding the data I use, please. Let us just use it to illustrate the whole rule of cessation. Look at it. It said JKL Nigeria makes up his account to 31st December. Means that the account is always make up to 31st December every year, and they permanently cease operation on 38th April 2020. You can determine the relevant year of assessment. So, what are the basis period and relevant year of assessment? In this instance, here, let us start from their ultimate year. Now, the ultimate year is what? Is April 20. The date the cease operation is April 2020. Look at it. April 2020, 30th April 2020. Now it will start from 1st of January of that 2020. That's why we say 1st of January 2020 to 30th of April 2020. And the year of assessment is what is that year 2020. Okay. Okay, I'm listening. You have a question? If you have a question, you can drop it in the chat so that we can continue. Now, please, it's very important. Let's continue, please. Now, I will answer the question later, please. Let us quickly go on. Now, in the 2020 year of assessment, the basis period it will now end in that year of cesations, which will start from 1st of January. This 1st of January is constant K. It is 1st of January of that year you ceased to the date you actually ceased. And the year of assessment is that year in question 2020. Why immediately a year before, which is the penultimate year? I guess you would do it either on preceding year basis or actual year basis. When I say actual year basis of 2019, that is 1st of January 2019 to 31st December 2019. When I say preceding year basis, that means what is preceding 2019? That's 2018 now. If 2018 was actually preceding 2019, so preceding year basis will end in 31st of December 2018 because the accounting year end is December. If it is March, it ends in 31st of December 2018, starting from 1st of January 2018, making it a year. Can you now see? This is an option now. The tax authority will pick either of these two, but the one they will pick will be the one that will be higher. I hope you get what I'm saying now. That is for hold rule. They will pick the higher of these two, and the ultimate year will run from 1st of January of that year of cessation to the date of cessation. And you use this to appropriate the profit you are getting. Now, in cessation now, what about if it's now a new finance act now? What happened? Now, the implication of the revision of cessation rule is that consideration of penultimate year of assessment is no longer relevant. There is no need for penultimate again. Because during cessation, sometimes we normally have a gap in basis period. But based on this new rule, the gap has actually been taken care of. Now, the cessation profit, the assessable profit of a company ceasing to carry on business is the amount of the profits from the beginning of the accounting period to the date of cessation. And the tax thereof shall be payable within 6 months from the date of cessation. What does that mean? It means that, the other time when you are starting in this year of cessation, you are starting from 1st of January of that year. You won't start from 1st of January. You will start from a day after the last year accounting period. I guess what I'm saying now. A day after the last year accounting period. If you look at 2019, the last year, if you use preceding year basis, what's the date, the last date here? 2018. Assuming this is what they use, they didn't use actual year basis. What's the day after this date? That's 1/1/2019. That means that this ultimate year will start from 1/1/2019 to 30/4/2020. It means that where the previous one ended, that is where this one will commence. I hope you get what I'm saying now. So if you look at it very well, you will not just say from 1st of January that it's constant. No, it's not constant. You will start from the end of the last account basis period. You start from the end, a day after the last period basis period. You now run it to the day they ceased operation. Now look at it. Let me even quickly illustrate it with a figure so that it will be clear. Here, look at it. How to deal with cesations rule. Apex Nigeria Limited that was incorporated in 1990. Incorporation is irrelevant. Even if you are doing pioneer and so on, it's irrelevant. Now, ceased operation on March 31, 2020. It means that the day of cessation happens to be what? Happens to be March 31, 2020. Having been in business for over 25 years, the accounting year of the company is December 31st, and that's December 31st is accounting year end. And it ceased operation on what? On March 31, 2020. Now say you determine the relevant year of assessment and the due date of payment of tax. Let's look at it. If it ceased on what? On March 2020, let me start from last year. And that last year happened to be what? The year they ceased operations. It ceased on 31st March 2020. Look at it. Look at what I'm saying. 31st of March 2020 is the last date. And that will start from the beginning of the last accounting year end. You know, the accounting year end of the company is always what? December. So if you look at it very, very well, December last year was what? 2019, December 2019. What is the date after this 2019? It's the 1st of January 2020. Are you getting me now? This is just a coincidence with the old rule. Because assuming this one was ending in March 2019, then this one will start from April, 1st of April 2020. I hope I get what I'm saying. Now, let me explain again. You know, if you look at it very well, in 2020, in this period, you know, they ended the business in March 2020. If they ended the business in March 2020, then what we need to do is that the date in which we run this period from will be a date immediately after the last accounting year end. You know, the last accounting year end was, you know, it's always December 2019. What's the day after this date? It is 1st of January 2020. That means that 1st of January 2020, which is the day after the last accounting year end, so the date of the session. Unlike the normal, the old rule where you would just say from 1st of January all the time. No. If this one happens to be ending in 31st of March, then this one will start from 1st of April. So please note it. So 1st of March 2020 to 31st of March 2020 session date. Now, what is the year of cessation of this? In the exam, to know, I mean, the year of payment of tax or year of assessment. To know when is the year of assessment, you need to look at this year, the date they cease. They cease in March. Now you now count from March. You now count 6 months from this March. If you count this 6 months from this March, I think it will run into September or so. Yes, September of the same year. If you can still count 6 months in this 2020, then the year of assessment will be 2020. But if you cannot count another 6 months after this end of the accounting year, end of that cessation date, let's say this cessation date is what is October 2020. If you are counting 6 months to add to it, it will be next year. That simply means that next year, which is 2021, will now be the time you will pay tax or the year of assessment. So please don't forget, if you ceased business within January to June of a particular year, you will pay tax in that year. That tax in that last year, you pay it in that year. But if the day you cease is more from July to December, you will do what? It will be the next year in which you was. Okay, I should do that again. I'm saying that so far, the 31st of March 2020 is the year you cease, the day you cease. Can you still count another 6 months from this March in this 2020? You now say April, May, June, July, August, September, making 6 months. And it's still that 2020. That means that you will pay tax, the final tax in 2020. But assuming the day they cease happen to be October or September, let's say October 2020, you still count the 6 months to join. Now, if that 6 months is tending toward next year, I guess that means that next year is when the year of assessment. But if the 6 months is still within that 2020, you pay the tax 2020. Okay, let's look at it. Assuming it's October 2020, it will now be November 2020, December 2020, then January 2021 is next year. That means that if you are counting 6 months, it will fall in next year. That means that the year of assessment will be 2021. So what we need to monitor is that if this is March, if this is January to June, this month, then you tax, year of assessment is 2020. But if it is from July to December, this last month, it is what? It is going to be next year. So please note that differences. This is very important. The next thing is now company contact. Now the examiner, in their own wisdom, company income tax is just is very important for this exam. It's very important because that is the real thing we are doing. So even if anybody says that there's not going to be calculation, no, company income tax can be tested, but that's the core of what of advanced tax. Now that's how to determine the tax liability of what of companies. I guess the following shall be discussed under the company income tax and so on: capital allowance, loss relief, and profit or loss of what tax liability of what of companies. And I know you know what is capital allowance. That's the what an allowance, a form of relief granted to any taxpayer or any company which incur as qualifying capital expenditure during a base period, respect of property, plant, and equipment, and so on. So you understand, capital allowance is just an allowance that the tax authority is given in exchange for the what? For the diminution in value of the asset. It means that if the asset is reducing in value as at the stage at what as exemplified or determined by the position of that company. I guess because what accountant understood is what is capital, I mean depreciation. But what tax authority what they understand is what is capital allowance. So depreciation is what is varies depending on the method of depreciation you are adopting. Therefore, it can distort the computation of what of the tax computation. Therefore, tax authority will say that depreciation you have removed, we don't want you to remove it, add it back. Then in exchange for it, we give you what? We give you a capital allowance. So now capital allowance I've explained now. So that this capital allowance now, there are different types of it: initial, annual, and what an investment allowance. Initial allowance is given once in the life of the business, and in the first year you use the asset, and it's always what? It's always given as a percentage. While the annual allowance is a allowance that is given in what on every year basis based on the useful life of the asset. And you understand that. And also investing allowance is an allowance that is given, additional allowance given to companies that are what productive companies that are into plant and machinery, that are using plant and machinery and equipment. It is not only plant and machinery. Equipment is also there. And the rate is always 10% of it, of that, the cost of that equipment. And note, you don't use the investment allowance to determine the tax liability, to determine the tax written down value of the asset. Also, we also have balancing allowance and balancing charge. Balancing allowance is when they are making a what? A balancing allowance is a loss. The tax, the recognition of what of losses in terms of tax authority. While that balancing charge is what gain, and those losses and gain are due from what? From disposal of what? Of the qualifying capital expenditure. So if you dispose assets and you are not in the ordinary course of disposing assets, your business is not in disposing, but coincidentally you have one or two cars you want to dispose and you dispose it. I get what I'm saying now. We want to look at if you dispose it, are you making gain on that disposal or you're making a loss? That is what you warrant what balancing allowance and balancing charge. All these were all very important. Now, the provision of the Act regarding capital allowance now, it means that when you are doing capital allowance, there is no need of what of a gap and overlapping again, because that take care of in the new finance act. Also, association there is no gap, at commencement there is no what, there is no overlap as well before. And calculation of capital allowance assets on assets acquired on higher purchase. If you have an asset acquired on higher purchase, how do you compute the capital allowance? My host, hello sir. Hello sir. Hello sir.
Hi, sir.
Yeah. Can you give me 10 minutes more, please?
Please go ahead, sir.
Okay, please. Wow, it's very unfortunate the time, but let us quickly use this next 10 minutes. Now, calculations of what of capital allowance assets, capital allowance assets on assets acquired on what? On assets acquired on a higher purchase. You know why I put this here? It's because if you look at the new icon pack, the first question they put in there is what? Sorry, please. 1 minute, please. Okay. Okay, let's look at it. Now, the reason why I have to put this here is what? The capital allowance happens to be the higher purchase transaction happens to be the first item they treated, first transaction they treated in what? In the new icon pack, the first example. So it's possible, when they ask you, how do you compute capital allowance on what? On higher purchase transactions? Calculation of capital allowance on assets acquired on higher purchase. Now, the higher purchase transactions will always attract interest cost. Now, in the cost of, okay, now look at it. Calculation of capital allowance assets acquired on higher purchase. Now, higher purchase transactions will always attract interest costs. So you see, what makes higher purchase is that person that is leasing the asset on higher purchase will get a gain, and that gain is interest. That interest element for the person that is collecting that thing on higher purchase, it should be an expense for him in the account, and it should have reduced the tax liability. But so far it has reduced tax liability. Are you going to also include it in your capital allowance computation? Because capital allowance is like a relief. If you do not remove that interest element before you compute your capital allowance under higher purchase, it means that you are getting double privileges. I get what I'm saying. One, as a tax, as a reduction in profits using the interest, and also second, as also using it to reduce to also increase your capital allowance relief, which will also reduce your profit together, because capital allowance will also be used to reduce the tax liability via reduction from profit. Are you getting me? So how do we now compute in the exam? When you enter into exam and you now see this, how do we compute the capital allowance using the capital allowance under higher purchase transaction? Now, the first thing you need to know is that the interest element should be removed. Just remember that in the exam. It should be removed from the higher purchase price. That is higher purchase price minus the cash price. You know that if you remove the cash and carry price, I mean the price that you should have bought it at cash and carry, if you remove it from higher purchase price, the difference will be the interest element. Now, identify date of agreement and pay special attention to date of payment of the support, deposit, and installment. You now need to focus your attention on what are those dates. What is that date they agreed and they pay the deposit and also installment? But that date is very critical. Calculate the amount paid on deposit and installment on due date. Where there is default in payment of an installment, identify the actual date of payment. It means that go and calculate the amount paid as deposit and installment. How much total amount paid as deposit and installment? Determine the relevant year of assessment and related business period of each payment. What installment of 5 installments? Identify that. In second year, maybe they pay 12 installments, identify it. In third year, maybe they pay 7 installments, identify it for each of those years. Then identify and add all payment deposit and installment falling within the basis period of each relevant year. It means that in that first year, how much of the deposit and installment that you receive added together. Second year, all the installments you receive added together. Third year, added together. So after doing that, then introduce each additional payment in EABO as if treating it a unit of asset newly acquired. You see, the one added in the first year, introduce it as if it's an asset and compute what and start the computation of capital allowance for this. In second year, introduce that also the addition that you have gotten as if you are introducing assets. In the third year, introduce the addition you got in the third year as if you are introducing new assets. And you now compute initial annual allowance accordingly. Hope I get me. Look at the way it will be done. Look at it quickly. On September 1, 2014, look at the statement, please. On September 1, 2014, Idiaraba Limited enter into higher will initial allowance be charged each year? Yes, initial allowance will be charged. I guess in the first year of introduction of each of that lump sum. I guess what I'm saying now. Yes. Why subsequently annual allowance will be charged? On September 4, 2014, Idiaraba Limited entered into a higher purchase agreement with Idiarere Limited. 10 generators was acquired on higher purchase. They acquired 10 generation higher purchase from Idiaraba Limited. with 2 million paid initial deposit. Look at the initial deposit, 2 million. That date, on that date, this was followed by how many installments? 24 equal monthly installments of how much? 200,000 naira, commencing from November 30th, 2014. It means that 200,000 for each of the installments, and you made that installment for 24 equal installments. Now, but if you are buying that generator on cash and carry basis, the 10 generator will cost 5.6 million. The driver limited usually prepares account to June 30 every year. They now ask you, compute the capital allowance for the relevant years of assessment. Now, compute the capital allowance for the relevant years of assessment. If you look at it very well, you now need to go and determine how do we determine it. First, go and determine the interest and remove that interest element, because I do that interest elements will be expunged from the computations. If you look at it, principal for capital allowance now, what's the deposit? The deposit 2 million, and installment is 24 installments of 2 million, which is 4.8 million. Add it together with the initial deposit, with the principal amount, and with the deposit, you have the what? Higher purchase price. Higher purchase price is the addition of what you deposited and what you pay in installments. That's what you are paying. You pay on cash and carry basis. That's what you pay on cash and carry. 1.2 million. 1.2 million is now interest element on the whole transaction. Now, the higher purchase interest 1.2 million. The number of installments is 24. Now, what is the interest element in each of the installments? You know, they have 24 installments. For each of that installment, there must be interest on them. How do we get the interest in each of the installments? Now, see, those total interest divided by what? 24. You get what? Interest per installment of how much? 50,000 naira. It means that for each of the installments of 200,000, 50,000 naira is what? Is interest element. Then go and remove the 50,000 from each of the installments. You now see the principal is now 200,000 minus what? 50,000. So that's 150,000. So it means that what you will use for your computation of capital allowance, it will not be 200,000. It will be 150,000. And that 150,000 is supposed to what? That's what you now use for the computation of capital allowance. Now look at it. How do you now compute it? You now need to go and look at the date. You know, they said the accounting year end of the company is every June. Now, if the dates in which go and check the dates of the deposit now. They deposited made the first deposit in where? In 2 million naira was deposited in 2014. If 2 million naira was on September 2014, it deposited 2 million naira. That's deposit. Then that simply means that what are the basis period that can capture that date? So that date must be captured in that basis period. You know, it's June every year is accounting year. Now, if I now say June 2015, end of the what? The first year is June 20, end of the what? June 2015. Then will you capture this 2014 1st of September? Now let us check it in their computations. Now look at it. You now see, you know, June 2015. It will run from 1st of July 2014. Can you now see? If you run from 1st of July 2014, it means that the first deposit will be within this date. That's what you look for in the exam. Go and look at the date that will capture that deposit. That basis period that will capture that deposit. And that basis period must end in the accounting year of the company, which is December, which is June. So this date now will make me to what? The initial deposit will be here, will be in this date. Now, if that is the case, then you will now use this date to now prepare other dates. Means that the next one, you know, if it is ending in 36/2015, then the year of assessment is 2016. That's preceding year. If it end, the next one will now say 1/7/2015. That's the day after this date to 30th 2016. The year of assessment is 2017. The next one is 2018. This is now the basis period to be used for your computation. Now, in this basis period now, for this first basis period, how many installments you see there and how much is it worth. Deposit will be there anyway. But initial deposit was captured there. 2 million was captured there. Then when do they start the payment of the installments? That is when you now see. That's when you now use to count how many will be in that first year. They started the payment of installments in November 2014. Now, commencing from November 30, 2014. That means that if they started from November 2014, let us now look at how many installments will be in that first basis period. You now see. Look at it. November, you now see November, December, January, February, March, April, May, June. End of the accounting year. Can you see? June. How many is that? 8 installments. Because the deposit. Don't forget the deposit was, look at the deposit. Look at the deposit was 1.2 million. And 8 installments now. The installments you will use, the cost you will use is 150, not 200,000 again, because you are removing interest. You now say 150,000 times 8. That will give you what? How much? 2 million naira. Can you see? 2 million naira plus 1.2 million. That's 3.2 million is what? Yes, it's in November 30. That date is inclusive now. Because the pay is on that day. Is that date not November? You can't November 30, that's November, December, January, February, March, April, May, June, 8 months. So far it is not December, it is still November. They paid it either beginning or end of the year. They made that payment in November. Please note it. So in that instance, please, my chairman, I will soon round up now. Now, if you look at it very well, in that November, you see, they pay deposits there in that period. In this first period, 17,040 to 30,015, they pay deposits of 1.2 million and 8 installments of what? 150,000 times 8. That's 2 million. I hope I get what I'm saying now. So now it simply means that the addition of what to be taken care of in first year is 3.2 million. If you now go to 2017, 2017 year of assessment will run, the basis period will run from a day after, immediately after this date to this date. Now it will now be 1/7/2015 to the next 1 year, that is 2016. That obviously is 12 months. Then 12 installments, because there won't be deposit in this period. Deposit is only once, and it's in first period. So 12 months is this. Okay? Now 12 months now, they said they have 24 installments. 8 months was captured in the first year, and in the first basis period. 12 months was captured in the second basis period. 12 plus 8 is what? Is a 20. How many months remaining? 4. That 4 will now start from will now fall in the next basis period. The next basis period is 1/7/2016 to 30/2017. That is when you see the remaining 4 periods. To make it what? 24. 8 plus 12 is 12. 20. 20 plus 4 is 24. That means that 150,000 times 4, because each of the installments is 150,000 times 4, it is 600,000. Each of the installments is 150,000 times 12 here, it is 1.8 million. Therefore, this is what you introduce in second year. This is what you introduce in third year for initial and annual allowance purposes. Then you now come here. You are introducing 3.2 million in the first year, and the first year you have assessment 2016. Then you now come, which is 3.2 million. You now come here and now say cost was 3.2 million. Can you now see 2016 cost 3.2 million? You introduce it as if it's the cost of the asset. Initial allowance, they are using 50% and 25%. Initial was 50%. 50% of 3.2 million is 1.6 million. Please look at it, 50% and 25%. 50% of initial allowance is 1.6. Why? 1.6 from 3.2 is 1.6. Then the annual allowance is 25%. So divide 25% is like for 4 years. So you now say the remaining 1.6 divided by 4, it give you 400,000. That means that in the first year, the balance tax receivable value is 1.2 million. That's 3.2 minus 1.6 and 4. 1.6 plus 4 is 2 million. 2 million from 3.2 is to give you what? 1.2 million. That means that in the first year, the initial allowance is 1.6, the annual allowance is 400, the addition is 200,000. So the capital allowance in the first year, that this higher purchase is 2 million. Now, this is where you now patience in the exam, assuming they ask. Now in 2017 now, we already have tax sitting value here. You now ask me, how many years is this one remaining to live now? Out of the 4 years, you have used 1 year here. So the remaining years should be 3 years, have you? Okay, now you now go that second year now. How much are we introducing the second year newly? You now go into the second year business period. Look at the business period second year. Second year, how much is it? You are introducing 1.8 million as an asset. So you now go there, you now say 1.8 million as an asset. Look at the 1.8 million. The cost was 1.8 million, is it not? So if the cost is 1.8 million, you will introduce it in the second year. Now you now say, the second year now means that it's remaining how many years for this asset in the second year? It's remaining 3 years. Because this is the second year. You count it from this second year down. It's supposed to be 4 years. But so far you're not starting from the first year, starting for the second year, then second year, third year, fourth year. These are 3 years is what this 1.8 million will use. Therefore, we now say initial allowance is still 50% of 1.8 million. That's what 900,000. If you move 900,000 from 1.8 million, it's remain 900,000, right? So far it's 3 years remaining. It will be 4 years now because this from second year. So now say the remaining 900,000 divided by 3 now. What do you have? You have 300,000. That's an allowance. Don't forget this first one that we started with. You will still compute an allowance on it too. The other allowance is still 400,000. Put it there, 400,000. So please note it. 400,000 for 1.2 million is 800,000. 1.8 million minus 900 minus 1, now 300. That's 600,000. Now see. In that second year, 2017 year of assessment, it will be 900,000 plus 400 plus 300, which is 700,000. Add the two together, we have 1.6 million. That's what capital allowance for the second year. Now the last year, the second to the last year, 2018, the tax sitting value is 800,000. This one is 600,000. Then you now introduce in the third year again. How much are we introducing in the third year? Go and check it. In the third year, third year 2018, we introduce 600,000 as the cost of the new assets. You now see, look at the 600,000 now. In the third year, 2018, the third year, you now see 600,000. Look at the third year. Third year is 600,000. That's 600,000. Initial allowance, you see 50% of 600,000, which is 300,000. But this third year now, is only third and fourth year remaining. That means that this will be 2 years remaining. It will be for this year. For this one, the way we have 3 years for this, the way we have 4 years for this. So if it's 2 years, if you remove the initial allowance 300,000 from 600,000, you have 300,000. That 300,000 divided by 2 because remaining 2 years, that will be 150,000. Don't forget, this one is still having 400,000 as the annual allowance. This one is having 300,000 as an allowance. Why this one will now be 150,000? Now, 300 is there. Add 400, 300, and 150 will give you 850. Capital allowance in 2018 year of assessment is 1,150,000. So lastly, the tax sitting value here is what? 800 minus 400 is 400,000. 600 minus 300,000 is 300,000. 600 minus 300 and 150,000 is 150,000. Then there is no introduction eligible. We registered all the costs now. So you just compute annual allowance for the fourth year. Fourth year annual allowance, just put 400 there, you give nothing. 300 here, you give nothing. But this one needs to be the third year, which is the last year. I get it now. You need to know it's 10 generators. Now say 10 generators times 10 naira per what? Per one. Because you need to leave a traceable value. I mean, a value in the account that will reflect until the asset is disposed. If the asset has not been disposed, it will still be seen 10 naira in that account. So by 10 generators, it will be 10 times 10. 10 times 10 is 100. That means that you remove 100 from what is 150,000. The balance is what you have is 1.9900. That's your capital allowance. So now you move 1.9900 from 150,000. You have what? 100. So this 100 is what is the traceable value of those assets. I get it. So if you add all these annual allowance together, 400,000, 200,000, 149,000, you have 849,900. That's the capital allowance for the 2019 job assessment. Unfortunately, I think this is where I'm going to stop. If you have questions, you can ask me personally. I mean, you can send it on the group regarding all the other topics. I get it. For those selected topics, you have to look at them. I get it. And all that topics in the syllabus, have the coverage of it. I get it. The PPT there, just look through it. I've simplified it there. I get it now. I've simplified it there. Just look through. I summarize those details that you need, and so on and so forth. The pioneer legislation also, I copy the question from your ICANN pack. I explain it there, and also the theoreticals and all that. I get it. Try to look through them. Ask me questions personally. I get what I'm saying now. If you want to online, on the what on the, they said, how did I get? You get the material 149,990. This will be 99. This will be 900, not 990, because it's 10 generators and 10 times 10, because you have to leave 10 naira into the account, and for 10 generators is 100. So if you move 100 from 150,000, I guess it will be 149,900. I hope you getting it. That's where we are. So please, I wish you guys the very best of luck, and I will see you open to what questions on the platform. I'll try. I can fish out me directly, one-on-one. To have me to have clarifications. I'll try. I know you have been what at the time is close. I know I will try our best. I get it now. Please, for this exam, try to be patient in the exam. Don't be in a hurry. I guess I know by God's grace, we shall all pass this exam by God's grace. You will not have any reason why you fail this exam. My number is my number. The number is on class. Okay, let me give it to you. 081 3899 8353. 081 3899 8353. Lastly, 081 3899 8353. Thank you so much. I need to thank my host, my chairman. I appreciate you. Thank you, sir. I appreciate it. That's the end of it. Thank you. Thank you for all the wishes.
Good night, sir.
Thank you, sir. Yeah, thank you.